Hello everyone and welcome to Financial Accounting. In today's video we're going to go over chapter 13, which is about statement of cash flows. So the statement of cash flows is one of the last statements that we prepare. It just focuses on cash in and cash out. The only difference is that, or compared to the income statement, is that it tries to split the flow of cash into three areas: operating activities, investing activities, and financing activities. So operating activities is the part that's more related to the income statement, but only focusing on the cash flows in and out, without it tries to ignore any kind of accruals. And then we have the investing activities, and that's only focusing on cash flows related to purchase and sales of long-term assets. And then we have the financing activities, which is usually the last section of the statement of cash flows. This focuses on equity and long-term liabilities. There are two approaches to prepare the statement of cash flows. There is the direct method and there is the indirect method. But the direct method and the indirect method only impact the first section, which is the operating section of the statement of cash flows. So let's start with what we mean by the statement of cash flow again one more time. So the statement of cash flows reports a company's cash inflows and outflows for a period. So as I said earlier, it only focuses on cash. It ignores anything else. And it's a good reconciliation for the cash that's presented on the balance sheet. So when we see the cash value on the balance sheet, it should be the same as the ending cash balance in the statement of cash flows. The statement of cash flows provide useful information about the company's ability to do a few things. Things like generating cash from operations and maintaining and expanding its operations capacity, meeting its financial obligations, and its ability to pay dividends. So as I said earlier, the statement of cash flows reports three types of cash flow activities, or I like to call it sometimes sections. So these activities are split into three sections. So we have the cash flows from or used for operating activities. We have cash flows from investing activities, and we have cash flows from financing activities. A good way to remember that is operating, investing, financing. Remember these three names, but the order is important too. So we always start with the last in the alphabet, which is operating, then investing, and then the F for financing. So the operating activities, these are the cash flows from transactions that affect the net income of the company. So anything relates to the operations of the business would be in the operating activities. Investing activities are the cash flows from transactions that affect investments in the non-current assets of the company, or in other words, long-term assets. The third section, which is the financing activities, are the cash flows from transactions that affect the debt or long-term liabilities and the equity of the company. And that's how it's presented. So we have the cash flow all reported in the statement of cash flows, where we have the three sections in the same order I just mentioned, where we have operating activities, investing activities, and financing activities. And then the total would be the net increase or decrease in cash. So if the cash flows are positive, in other words, the cash is going up, then we have a net increase. If it went down, then we have a net decrease. This net increase or decrease in cash will be added later on to the beginning cash balance, which we bring from the last year's balance sheet. And then once we add these together, the change in cash, where it's increase or decrease, we add it to the cash at the beginning of the period to get the cash at the end of the period. So the ending cash on the statement of cash flows equal the cash reported on the company's balance sheet at the end of the year. And this is a good confirmation, or we can call it like we're reconciling here whether the statement of cash flows shows exactly how the cash balance is presented on the statement of or in the balance sheet. One thing I want you to remember is that the statement of cash flows is not like the bank reconciliation statement. The bank reconciliation is something that explains the difference between what we have in the cash balance in the bank and the cash balance on the balance sheet. Here we just explain a little bit more how the cash has increased and decreased and what are the things that impacted the change of cash. So the sources and uses of cash. If we look at the operating activities, the sources of cash, which are the inflows. These are from the sale of products, from providing services. For the outflows would be the purchase of inventory to pay employees, to pay taxes. For investing, that would be the inflows would be from sale of property, plant, and equipment. So if we sold an old equipment, we sold building, we sold land. From the sale of investment, if we have investment in stock and other long-term assets. And then for the outflows would be buying property, plant, and equipment or purchasing investments. For financing activities, we can see here that the inflows are coming from the issuing of long-term liabilities, like issuing a bond or issuing new common or preferred stock. For financing activities, it would be for paying dividends to shareholders, to repurchase common stock, which we call a treasury stock, or to repay a long-term liability. So when we fulfill the long-term liability, we're paying it out. That's part of the financing activities. One thing I want you to remember, if we're paying interest on a long-term debt, that would be part of the operating activities. So let's start with the first section, which is the cash flows from operating activities. And again, it's cash flows from or used for operating activities. Report the cash inflows and outflows from a company's day-to-day operations. So it's a reflection of the net income or the income statement, but it only focuses on cash transactions. So anything on accruals are not reported on the statement of cash flows. Companies may select one of two alternatives or two alternative methods for reporting cash flows from operating activities on the statement of cash flows. It's either the direct method or the indirect method. From what I've seen, the indirect method is the most commonly used method. Why is that? Because it's easy. I would say more straightforward. The thing is, if you use the direct method, according to GAAP, you still have to report the indirect method. So, because the indirect method works as a reconciliation to the income statement. So both methods result in the same amount of cash flows from operating activities, because we're only presenting how cash has changed. It doesn't matter whether we use direct or indirect. So we're not actually doing a calculation here as much as presenting how the cash has changed. So we are required in all means to use the indirect method. If we use it alone, that's fine. But if we decide to use the direct method, then we also have to support that with the indirect method. For the sake of this presentation or this discussion here, we're only going to focus on the indirect method. The direct method is presented in the appendix, which I'm not going to cover in this chapter. So I'll just give you a brief idea about what is the direct method. So the direct method reports operating cash inflows, which are the receipts, and the cash outflows, which are the payments. And you can see here we have cash received from customers, cash paid for merchandise, cash paid for operating expenses, for interest, for income taxes. We add all these things together to get the cash flows from operating activities. If it's negative, we call it cash flow used for operating activities. In most cases, we would like to see a positive cash flow from operating activities, because that would show that the company is profitable. Or in other words, has a positive cash flow. It's a good thing. So the primary advantage of the direct method is that it directly reports cash receipts and cash payments for each operating activity on the statement of cash flows. It's very straightforward. It just shows you the value for each category spent without any calculation. So you don't need to think too much, unlike the indirect method, because the indirect method we start with the net income and we reverse things. Here it's direct. We're just seeing how much cash was received and how much cash was paid directly. The major disadvantage of this is that these data may not be readily available in the accounting records, so we need to do a lot of work in order to prepare the direct method. And then the indirect method, we already have the income statement prepared, so that's much easier. So the indirect method reports cash flows from operating activities by beginning with net income and adjusting it for revenues and expenses that do not involve the receipt of or payment of cash. So we start with net income, and where we get that from the income statement, and there's no way we can prepare the statement of cash flows using the indirect method unless we have the income statement prepared already. And then we do some adjustments to reconcile net income or loss to net cash flow from or used for operating activities to get the net cash flow from or used for operating activities. This value, whether it has to be equal to the direct method. It's just a different way of presenting it. What's the advantage of the indirect method is that it reconciles the difference between net income and net cash flow from operating activities. That's the best thing about it. So as you can see here, in the direct method or in the indirect method, the amount of net cash flow from operating activities are the same. So 2,900 and 2,900. It's only how it's presented. So in the direct method, we just directly see the cash received from customers, and we subtract the cash paid for expenses to get the amount of net cash flow from operating activities. In the indirect method, we start with the net income from the income statement, we make some adjustments, and we'll talk about these adjustments later, to get the net cash flow from operating activities. But the end result is the same. It doesn't matter whether we went direct method or indirect method. Let's speak about the cash flows from investing activities. So investing activities, as I said, this focuses on long-term assets. It shows the cash inflows and outflows related to changes in a company's long-term assets. Cash flows from investing activities are reported on the statement of cash flows as follows. We start with cash flows from investing activities and cash used for investing activities. We get the difference, and that would be the amount of net cash flow from investing activities. If the company purchased a major fixed asset, then we expect that the net cash flow would be used for investing activity. It would be a negative result. If they mainly sold assets, long-term assets, then this would be a positive value. It's not really concerning to have positive or negative as long as it's not persistent from year to year, and as long as the operating activities can cover this investing activities. But the more important is the operating activities to be always positive. In the investing activities section, we don't have the choice of going direct or indirect. It has to be direct. We don't have an option. Indirect is not even possible here. Then we have the cash flow from financing activities, and that's cash flows from financing activities, shows the cash inflows and outflows related to changes in the company's long-term liabilities and the stockholders' equity. So when we're issuing new stock, or issuing new bonds, or we are actually buying treasury stock or fulfilling our long-term debt, then in this case the financing activities would be impacted. And that's how it's reported. We show the cash inflows from financing activities minus the cash used for financing activities, and that would give us the net cash flow from financing activities. So these three sections, we add them together, add them to the beginning balance of cash to get the ending balance of cash. Now let's talk about something that's not really directly related to cash, but impacts the statement of cash flows, which we call them the non-cash investing and financing activities. In some cases, a company may enter into transactions involving investing and financing activities that do not directly affect cash. So a company may issue common stock to retire long-term debt, for example. So although this transaction does not directly affect cash, it does eliminate future cash payments for interest and for paying the bonds when they mature. Because such transactions indirectly affect cash flows, they are reported in a separate section of the statement of cash flows. And they're just reported as a form of a footnote, explanation that we had this major non-cash investing and financing activities that would have an impact on cash in the future. Now let's talk about the format of the statement of cash flows. So as I said, the statement of cash flows presents the cash flows generated from three activities. We have the operating activities, we have the investing activities, we have the financing activities. These three activities are always reported in the same order. So the easiest way to remember it is that we go from the latest in the alphabet, which is operating, and then investing, and then financing. I'm talking here about the order. So operating, investing, and financing. So I think that's the easiest way to remember that. And that's how it looks like. As an example, for a company called Rendell, we see the statement of cash flows, we have the operating activities, and then investing activities, financing activities, and then we get the net increase or decrease in cash, depending whether on the total of these three numbers would lead to a positive or negative value. And then this amount of net increase or decrease in cash is added to the beginning balance of cash to get the ending balance of cash, or cash at the end of the period. And then we have later on the non-cash investing and financing activities. This just shows the major kind of non-cash investing in financing activities. Again, it's just as additional information. One last thing before we go a little bit more into the operating activities section and see how we present the indirect method, which is the no cash flow per share. The cash flow per share is a tempting measure to calculate, yet we should not do it. So cash flow per share is sometimes reported in the financial press, but from financial perspective, this is not a correct thing. It's not like earnings per share, and it can get confusing with earnings per share. So as reported, cash flows per share is normally computed as net cash flow from operating activities divided by the number of common shares outstanding. However, such reporting may be misleading because of the following. The first thing, users may misinterpret cash flow per share as the per share amount available for dividends. Also, users may misinterpret cash flow per share as equivalent to or better than earnings per share, which is not true. So for these reasons, the financial statements, including the statement of cash flows, should not be reported or should not report cash flow per share. So let me stop here. In the next video, we're going to be going over the operating section, and we're going to see how the indirect method is calculated.